Hey guys, welcome into today's video. Today we talk about the free stocks I will be buying now between the end of April and May. And I didn't do this series for quite some time for respect for all of you guys, because I knew I was mentioning on the channel the markets were going on a crazy bubble, and I had the belief that whatever we would be buying, we could have bought at a better price when the market would have done a decent correction. And that's, I believe, right now the case. Everything went down. The market is at the 20 weeks moving average, which is a very interesting buying opportunities. Many things are still overvalued and there is still room for markets to go down. But I have here with you 3 companies that I believe at this price are very, very, very good buys, could give us very good returns across the year, and I will be adding to my portfolio. If you will like the video, guys, subscribe to the channel, click the like button. And before we start, guys, if you want to sustain the channel, please subscribe to the Patreon. It's $5 a month and you can follow my portfolio and what I'm doing. To be sincere, I didn't do much in the months where I started. There was no buying opportunity. I will not publish a lot on this Patreon, to be sincere, but I will publish when there is a good opportunity, when we buy some stocks. It's a long-term portfolio. So few activities here, but I believe long-term results will be very good. Let's go to our first buy, which is Axelis Technologies. This is a semiconductor company that has fantastic financial, fantastic growth, very good product, and it's not growing so much as the AI bubble. And now with the crash of semiconductors, it came to an incredible good buying opportunities. Here are their semiconductors. I follow some experts which analyze the products and consider them very, very good. I'm not an expert, but what I can see are the financials that are really, really, really outstanding. I will show you the fundamental picture of this company. The current price is 94. Analysts see it at 160, which I believe makes sense. It has a PEG ratio that is very, very honest at 1, which is the Peter Lynch favorite indicator, a price to E before 13. For a company which grew 30% in the last 5 years compounded, has a very good quick ratio, has a very low debt to capital, below 5%, is growing sales 22% per year. It has a fantastic EBIT, which is covering very, very well the interest rate on the debt. It was beating constantly the analyst, has a 16% beating on analysts, so it gets a fantastic score of 13. In my tool, and when I look at my discounted cash flow model, it is 85% undervalued. So the fair price would be 192, assuming a 14% growth at current level. The company is growing a lot more than that, and is growing, reducing the number of shares. Like, this is the free cash flow and the net income. You could see from this level where we had 11 net income, now we have 136 and 214. So you see how much this increased over here. And when I look at the balance sheet, number of shares is reducing. This stock is now at a very, very good technical level. If I see here, yeah, maybe could go even a bit lower here. Could go even at 80, which is a good opportunity. But considering that this is a point where the markets are a bit retracing, we have insiders that started to buy the company, and I see a potential double here, I will start to add the company to my portfolio. That's the first buy, Axelis. The second company, which I believe is a fantastic buy, is DLocal. DLocal is helping some of the biggest companies in the world, like Amazon, Dropbox. You can see Nike as very, very important customers to work in emerging market and help processing payments, collecting payments, Booking.com, Temu. It's growing like crazy. This company is growing like crazy. It's 800 plus employees, 40 plus countries. Payment solution, reach billions of new customers in high-growth markets through a single integration. Ability to accept local payment methods and facilitate cross-border fund settlement worldwide. The locals offers ideal payment solution for global commerce. So this is a company growing very well, helping growing in emerging markets, Africa, Asia, Latin America. So these are countries where there could be growth. This is a really, 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 really interesting business. If we go at the fundamental picture of this company, let me filter the local. We got a very solid net margin of 22 point, almost 23%. PEG ratio of 0.96, which is very, very good metric. Like you pay a P which is lower than the growth. A price to earning of 26 for a company which is expected to double almost in a couple of years. Return of investment of 35%. Sales growth of 55% year on year. You're paying a very, very, very good price. The company has no debt. 7%, like 0.7%, not even 7%. Quick ratio 163. This company gets also a very, very high score of 12 in my fundamental analyzer tool. If we look at, on the other hand, the discounted cash flow for the local, if we look at the discounted cash flow, we see that giving to the company an expected growth of 12%, which is a lot lower than what is growing right now the company seems to be worth 33, which is over a double from current level. The company seems to be quite solid. Like, let's have a look at the income statement. You will see a massive look the revenues, how much they are growing exponentially. It's really difficult to find what can go wrong in this, because the fact is that it's also diversified in multiple continents. So it's very difficult to see what can go wrong. Net income from 15 to 115, 10x in 10 years. And, we aim for a growth which is much below that. The fact that they cooperate with the best companies, I think it's efficient for the bigger companies because they can delegate these activities to this one. Free cash flow, nothing wrong with that. The analysts see still a growth of 50%, 36%, 31%, 29%. I don't know really, guys, what can go wrong. I mean, there is always a possibility that something can go wrong in an investment, but buying such a growth company, such solid balance sheet at such good value, see, like the half of the IPO price, I believe this could be a multi-bagger. So I will be adding the local to my portfolio. All right, guys, the stock number 3, I see a bit less upside than the other two, but I believe could be also a consistent grower in the year. This is Match Group. Maybe the name itself will not give you too much, but is the owner of Tinder and few other dating application. What is the investing thesis here? Tinder is the leader, for sure. Is the leader in dating. Like, when you think about the dating application, you think about Tinder. And like I see in this world, dating going up, not down. Elliott Fund, which generally is a group of sharks in finance, are entering this as active investors to make the company go even better. And I see it very, very solid because anyway, I don't see people getting too much in couples. People that are single will always have the desire to use Tinder. I think this is a company which can grow solidly. If we look at here, Match Group, let's have a look. 20% margin, still good, company making money. PEG ratio 0.51, very low. Price to earning 14, very reasonable. Analysts see the growth, very good, very, very good. Like, I think that's a 10% growth yearly. 5 year, this is showing negative because, okay, in COVID they grew a lot. So that's a, let's say, negative point. Return on investment is improving anyway, so the company is doing the right move, is beating expectation, financially solid, with an interest coverage ratio of 3, and the company, seems that there's no debt as well. So it gets a total score of 8.5. 8.5, if I do my discounted cash flow and I give a growth of 8%, which I believe is reasonable, the company appears in all metric 30% undervalued. 30% undervalued is not bad for a company like Tinder, which I believe has a moat, because if you think about dating, you think about Tinder. So I like the fact that there is Elliot. They are doing buybacks. Let's see if we got here the number of shares, which is another good thing. If I look at financials, 32, yeah, now it's 32, it's not 34. So the value, the upside could be even a 40% rather than 30%. If we look at the balance sheet, we want to see the outstanding shares. You see that they were increasing a lot till 2019. Now the company is trying to lower. They move from 285 to 268. So yeah, like very, very solid grower. Could also be potentially bought by some other companies. I believe there is really good value in Match/Tinder. So guys, if you want to see the full portfolio, don't miss out. The Patreon portfolio you will find here. I will add these 3 companies to the portfolio. I wish you a wonderful, wonderful weekend.